I will talk about Michael Burry's investment strategy, who we all know from the movie The Big Short, and how his predictions for 2023 are not at all optimistic. According to Burry, investment is neither art nor science, but rather a scientific art. Michael Burry, born in 1971 and victim of cancer that caused him to lose an eye at the age of 2, and affected by Asperger's syndrome, is an unusual investor. He is in fact a medical graduate, and initially finance and investments were more of a hobby than anything else. He started his career by publishing his investment ideas on message boards such as Silicon Investor and on his totally private website. This attracted Microsoft's attention, which invited him to participate in the MSN Strategic Lab, where he shared his investment choices in a virtual investment challenge. He practiced medicine until 2000, when he decided to dedicate himself completely to investments and opened his Cyan Capital investment fund. In his first year, the fund recorded an impressive performance of 55%, while the S&P 500 lost 11.8%. In 2008, he earned $700 million for his fund and $100 million for his personal fortune with The Big Short. His investment style and philosophy derived mainly from Benjamin Graham and David Gould's book, Security Analysis, also a favorite of Warren Buffett. However, he believes that to invest, you must rely on your own instincts without following any trends or currents of investors. In one of his quarterly letters to investors, he explains his methodology, stating, "My strategy is not complex. I try to buy shares of companies that have had car accidents and sell them when they are cleaned up and fixed." He explains that the first step is based on research, and without a thorough study to understand the value of a company, it is not worth a penny to him. He is not interested in the market in general and places very few limits on investment possibilities. Invest in large cap, small cap, and micro cap, anything that moves on Wall Street. For him, if it has value, he buys or sells it. According to him, the best investments are made in sectors that are undervalued by the economy. Burry's stock picking is based on the margin of safety, which is the difference between the intrinsic value of a stock and its market price. As a first filter, he looks at the ratio of enterprise value to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. This tells him the company's operating profitability by considering only the business-related part. Depending on the economic cycle, he tries to give a price to the company to decide whether to invest in it or not. This involves observing the real free cash flow and considering off-balance sheet items. He prefers companies with low debt because he believes that part of risk management is ensuring that a company can survive on its own even in tough times. He ignores the price-to-earnings ratio, for example, to avoid being misled by a company's declared metrics. Michael Burry also invests in what he calls rare birds, which are opportunities for arbitrage. He invests in companies that sell for less than 2/3 of their net worth, which is net current assets minus liabilities. For example, net Ben Graham stocks or companies that sell for less than their liquidation value, just like Warren Buffett. He also invests in companies that have a competitive advantage, but he considers it a long-term view. According to Burry, risk is not defined by volatility but by poorly conceived investments. In fact, he believes that volatility represents a good opportunity to get by. He believes that portfolio management is as important as stock selection, and that a good investor must answer some questions, such as what is the optimal number of stocks to hold in a portfolio, when to buy, when to sell, and whether to consider the difference between cyclicals and non-cyclicals. He likes to hold between 12 and 18 stocks from different sectors in his portfolio to minimize correlation. Among his best ideas, he tends to invest all of his capital and keep little liquidity. When a company earns 40 to 50%, he does not hesitate to sell and take home the profits without worrying too much about taxation. He aims for a portfolio turnover of about 50%. When buying a stock, he also relies on technical analysis, a tool he has been using since he was a commodities trader in his previous experience. He tends to buy between 10 and 15% of a minimum of 52 weeks as the stock price. If it is a loss-making company and sees that it registers a new low, he does not hesitate to cut the loss. He explains that it is not in his nature, but since implementing this rule, he has not risked destroying his portfolio. According to him, many investors, when they are losing, increase their risk tolerance and become more aggressive because they have to make a greater performance to return to profit. Furthermore, he does not consider fundamental analysis infallible, but as an increase in probabilities in his favor. Burry admits that he can be wrong sometimes. After talking about his investment strategy techniques, let's analyze his predictions for 2023. Burry had predicted a strong increase in inflation in 2021. He was not the only one when central banks were still talking about transitory inflation. On January 2nd of this year, he tweeted that according to him, there will be a decrease in U.S. inflation, especially in the second quarter of 2023. However, the U.S. will be in an economic recession, so the government and central banks will be forced to cut interest rates, leading to an increase in inflation again. Although to tell the truth, the president of the Fed has explicitly stated that he does not want to make the mistake that Walker made in the 1970s when inflation was at 14%. In fact, in 1977, inflation dropped due to a reduction in rates and recession. But after 2 years at the end of 1979, the consumer price index was back in double digits, printing at 11.3%. The signs of a frequent recession, according to him, are evident to all economists who predict that consumer spending, which represents 2/3 of the American gross domestic product, will barely increase in the central 6 months of the year, with median estimates predicting economic growth of only 0.3%. In addition, higher interest rates can lead to a decrease in corporate profits, accentuating the slowdown in gross domestic product just before the FOMC meeting. The investor tweeted in, although it is impossible to really understand what he meant with just one word. Many investors on his Twitter profile have misinterpreted his message, and at the end of the meeting, when the stock market rose, they began to criticize Burry's wrong prediction. Michael probably did not refer to the meeting itself, but has a perspective based more on the medium to long term. Therefore, we will analyze some of his previous tweets to better understand what he has in mind. At the end of December, he stated that the end-of-year rally reminded him of 2002 when many investors bought technology companies because they were cheap. Burry has argued for years that stocks are overvalued compared to historical levels, even predicting in May that the S&P 500 could fall to 1,862 points. In the graph he shared from 2000 to 2001, the S&P 500 had a strong rally after the Fed's rate cut in September 2001, leading some investors to believe that stocks were destined to rise again. However, the market rally lasted a short time and the market continued to decline for more than 12 months. Let's try to understand what Burry means with that tweet. If we consider the performance of the index from 2001 to 2022, we see that the first two retracements were around 10% and the third was 18%. The fourth was 25%. If we look at the graph today, we can see that the first three retracements are actually very similar to those of 2001. The fourth retracement, which we are currently experiencing, is around 20%. According to him, after the market finishes retracing, there will still be ample space for a descent and another bearish leg, just like what happened during the dot-com bubble. In his latest tweet, he inserted a graph of the S&P 500 from 2001 to 2002, overlaid with Fat Fan's rate, with the caption, "This time is different." He refers to the fact that in 2001, the bear market was accompanied by a cut in interest rates by the Fed. Looking at today's graph, where we have the American index at the top and Fed interest rates at the bottom, it is quite evident that while the market is falling, interest rates are actually rising, and they are doing so at the fastest pace ever historically. An interest rate hike is typically negative for the market, which is why he believes it could still decline. In conclusion, Michael Burry tells us that he does not believe in this market rally, and that it will soon end, although we may be close to a Fed pivot and a change in direction of the Fed. If inflation remains high, for example, he invests in an ETF Vanguard VNQ that holds real estate in its composition and invests in sectors such as prisons, which are considered anti-recessionary. He also explained that he invests most of his wealth in agricultural land, which is considered inflation-resistant. In the movie The Big Short, it is stated on a sign that Burry is basing his entire trade on water. In an interview, he clarified that he was referring specifically to agricultural land. Recently, he stated that he believes that agricultural land with water on site will be very valuable in the future. That's why he invested a considerable amount of money in it. He is investing in alternative investments, but he doesn't want to reveal too much. In conclusion, we have understood that Michael Burry is what is called a perma-bear, meaning that he has a perpetually bearish and catastrophic view of the financial world. However, unlike many others, his approach is quantitative based on data, mathematics, and statistics. We will see if, like in 2008, his predictions will be correct. One thing to remember is that, if you haven't seen the movie, I'll give you a small spoiler. It took 2 years before Michael Burry's vision and investment positioning in his portfolio saw positive performance. He risked a lot to follow his idea based on numbers and statistics, but as often said, the market can stay high and go against what the macroeconomic data is telling us for a long time. This is something that we probably cannot afford with our portfolio and our money, so always be on the lookout. While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video, click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.